Fantastic. Thanks to the guys at Arcos Labs. Now, I've had the pleasure of knowing Sean for, I think it's maybe even nearly 15 years. I actually think that this is the turning of the tables. I do remember 12 years ago being interviewed when you were at Trulia, and now I think we're going to turn the tables in this session. So Sean is the CEO and co-founder of Knock in the US. He has a long history of being involved in successful businesses, including Sales Crunch, which he founded and was sold off or acquired by ClearSlide, and was in Trulia, who was part of the founding team and head of sales and operations, which was clearly purchased by Zillow back in the day. So fantastic, Sean, to have you here. Now, can we start off by, everyone thinks of iBuyers in the US and they might actually put Knock in the same category. So maybe you can give us a bit of an overview of what Knock does.
Yeah, thanks, Simon. Good to see you. Thanks for having me. So Knock's quite different from an iBuyer, although as we all came and emerged as a prop tech group, which wasn't a word, by the way, when we started. We all kind of got lumped together. But Knock is a home trade-in platform, marketplace, and we try to make it easier for the 2/3 of people who are purchasing a house every year, 2/3 of the 6 million that are also selling at the same time, and more than likely have all their equity tied up in the old home. They're usually, professional and or working folks with families, and they're busy, so it's really hard to juggle and time the transaction perfectly. And so we make that a lot easier.
Okay, so and specifically, how do you do it? I want to buy a new home. I come to you and I ask for money, and to make that process happen. And then how do you make your money in that process?
Yeah, so the way the process works for the customers, they come to the site and they type in their address. We immediately pull up all the public data like we did at Trulia. And you tell us sort of like what renovations you've made, and we're effectively trying to figure out how much your home is worth. We'll ultimately come and inspect the property and put a final price on it. But we're not going to buy that property the way an iBuyer would, because ultimately it has to be done at a discount to take all that risk and all that expense. We're just trying to figure out how much equity you have in that property and how much house you can afford on the other side. And we use data science to do that. Our first technical hire, besides our co-founder, was a data science. We have a pretty decent sized data science team. So we're using algorithms and we call local licensed experts, salaried agents, to figure out that price. Once we get comfortable with not only how much the house will sell for, but how long it'll take and what it needs to get market ready, we get them pre-approved for a mortgage, which we also now do internally. And that gives us the two elements they need to go and buy their new home. We help them today shop for that home. When they identify it, we make an all cash offer on their behalf. So it's non-contingent, and we purchase that home with them. They move in. Then as soon as they're out of their old home, we put up to $10,000 worth of work into it. They approve it. And once it's sold, the transaction is complete. So they get the convenience of not having to live through repairs, not having to live through showings, being able to have instant gratification and certainty on the new home. And then when the old home is sold on the open market with multiple offers, usually, they get all the equity out, they apply whatever they want to the new home, close on the new mortgage, and they're done.
Okay. And how do you make your money?
So we're fully integrated. We are the broker, so we get the commission. In the US, it's 3% on either side. If you're the buyer, agent, and broker, and the seller agent on the other side. We have had title for about a year now. We've integrated that.
Sorry, Sean, just for those outside of the US, what does having title mean?
Oh, title insurance is a wonderful US phenomenon where you effectively have to pay a couple $1,000s every time you buy or refinance your home to make sure the chain of title, the chain of ownership, is clean and there's no liens. And so, it's a requirement in the US. The mortgages companies all require it. So title is insurance, effectively, to make sure that if for some reason a claim comes in the future, you're covered. You did your work. So that's a couple $1,000s per every time you use it. And then mortgage. We now integrated mortgage in Knock Lending. And so the idea is that you have one throat to choke, one place to call for all that you need. Otherwise, you're having to do a massive project management, and you probably don't have that experience as a consumer trying to manage all these people and all these timelines and make it all sort of come together at once.
Okay, which sounds like a great business to operate. Do you make any money on the money that you lend? So you're lending someone money to buy a house, and then you're getting that money back through refinancing or the sale of the old house.
Do
you make money on that?
What ultimately our goal and what we've actually accomplished is we want to make it cheaper to do it this way than it is to do it the traditional way. And so, for example, when we're buying the new home, we are using debt to do that today for a short period of time until their home is sold. But we effectively pass that cost on to them directly without marking it up, because we're already making. We had a thesis at Trulia back in 2005 that, like, Pete, my co-founder, is British. My other co-founder, Sami, was Finnish, and they come from a 2% European commission world. And we had hoped Trulia would have had a bigger impact on the 6% commission, because it creates a lot of friction for consumers to buy and sell more often. And that didn't happen in the first wave, unfortunately. And we're trying to make that happen. And you can't actually force prices down. Redfin tried it, semi-successfully. They did it really well, but it just shows you the market forces of that scenario. So when we're buying a house non-contingent, meaning our customer doesn't have to make an offer contingent on their house selling or the mortgage closing, because all that's been done, we actually end up getting a discount on the new home of 3 to 5% that we also pass along to them. So we've always felt that, like, the commission in the US is already too much. We're not going to charge more. We're going to pack a bunch of value into it. And that's convenience and certainty and cost effectiveness. So we feel like it's enough that we're making 3% plus the mortgage plus the title. Like, that's enough. And in fact, we can make those even cheaper because we're, putting it all into one, experience. And so there's a lot less work and manual work. So no, we don't make any money on the markup. We just pass along that cost for whatever period of time they're in the new home until it takes the old home, which is usually 90% of our houses sell within 90 days, meaning that transaction, they're waiting 90 days, and that's 90 days of financing at high single digits.
Okay, now clearly when you're purchasing a whole bunch of houses on behalf of people, that costs a fair chunk of change. Where do you source your funds from? Is it your money? Are you using third-party money that you're giving a good return on?
Yeah, a little bit of both. So we typically have a couple lines of debt that we use. The main one is against, it sort of like sits on we call it the first on the property. So the first lien is like 85, 90 cents on a dollar that we can use from our primary debt provider. So if it's on average a $350,000 or $400,000 house, 90%, 85, 90% of that is the primary debt provider. And then on the rest, we have other kinds of debt providers, and sometimes we just use equity because if it's short enough period of time.
Okay, now clearly there's an interest cost associated with that. That's passed on to the home buyer.
Yeah, and that's the one where and it's variable, because if they're only in the new house for 45 days until the old one sells and closes, then they're only going to pay 45 days worth of interest, and it's 9%. So it ends up being hundreds or low thousands of dollars. And again, the real cost that we incur is like when we buy the house, we have to pay title, which I mentioned. We have to pay HOA fees or common charges, as you may know them. We have to pay like transfer tax. That's the real upfront transactional cost. But again, that's mostly offset and then some by the discount we get on the new home. And we're coming into a new evolution of the model, which I can't talk a lot about, which will reduce all that stuff even further.
Okay, so then the question that comes up is, what happens if you buy a house for someone and the old house doesn't sell?
Yeah, well, I think this is true everywhere in the world. Every house has a price. So we do a lot of work on the front end. First of all, we make sure we're in 6 markets now, and they're Atlanta and Charlotte, Raleigh, Dallas, Denver. We just launched Austin a week and a half ago. We're going to launch 6 or 7 more markets this year. These are cities where people, even before COVID, were flocking to, because San Francisco's too expensive, New York's too expensive, and businesses are flocking to. So there's a lot of density, and there's a lot of data, and there's a lot of uniform housing stock that we can price. So we're doing a lot of things to make sure that that we're safe and they're safe. And we have an algorithm that's now a machine learning algorithm that's now its 3rd, evolution. And we have local licensed experts, people that know the market. So we're making sure that, that house, we're pretty close. In fact, we predict home prices nationwide, and we're within 2% half the time. However, we also make sure that the homeowner has enough equity in that home. On average, our customers have 30 to 40% equity in their old home that they can withstand some volatility, seasonality, et cetera. So it almost always sells at some point. The question is how long? And 90% of our houses sell within 90 days. And in fact, in this recent COVID, quarantine, they were selling even faster because inventory here is super tight. And it was tight before, now it's even tighter. And people want to get out of the small house they have because they realize how small it is now, being sheltered in place.
Yes.
So like in a worst case scenario, and it's an outlier where for some reason the house takes longer, we'll usually help the customer. We have a fixed fee, by the way. So we say like, it's going to cost you no more than X. If we're wrong and it takes 9 months, then like the clock stops at like 90 days or 120 days usually, and we eat it, right? So it's a very small percentage of the time, and it's like a insurance policy, right? We write it off to make sure they're in a good place.
Okay. Now you said that, the core business is helping someone finance the movement to a new house, and you've got that up to 90 days on average. And then on top of that, you've got these other products, title insurance, mortgages, etc. How do you bundle all that together? How do you ensure that people are buying multiple products from you?
You almost kind of have to, right? So we have RESPA rules here in the US that came out of the 2008 downturn and mortgage crisis. But so you can't force someone to use your mortgage company or a mortgage provider. However, going into this trade-in, we say like, we have different products, but you have to use these things. If you don't want to use them, then you can't do the trade-in, right? So they're all like tightly integrated. We can only lend money on the new home if we feel really good that we've underwritten the old home, meaning we've, done the work to figure out how much it's worth. We know we're looking at it online and monitoring how long it's taking. If we need to make adjustments, we're able to do it. We control it, right? So it only works if it's integrated. And frankly, from the customer's point of view, it's competitive. Price-wise, title insurance, you can't actually compete on price. It's regulated. So it is one price regardless of what company you use. So it's a non-issue. And all the big underwriters on the back and behind everybody are the same. There's like 4 big companies. And then, on mortgage, we're competitive. You can sort of shop around. So like from that point of view, the customer, all things being equal, just wants one party to like take care of it all. So it becomes less of a you don't really have to fight with the customer because they're like, hey, all things being equal, and this is competitive from a cost perspective. In fact, I'm even better off cost effective, from a cost perspective, and you're doing all the work for me. Go for it. Because by the way, we're lending them not only the money to buy the new home, we're also lending the money and managing the contract work on the old home so that they don't take longer. The contractors don't take advantage of them and charge them more or take longer and disappear. We do all that.
So what are the challenges for you in running this model and then expanding the model beyond the 6 markets you're operating in?
What are the challenges? So I would say customer acquisition, just because, we do a lot of TV and online marketing today very effectively. We do it on a performance basis. We're measuring every dollar, where it goes, what show, what time of day, et cetera. But that when you roll into a new market, there's a certain amount of investment you have to make before you get whatever the magic touch number is, 7 touches, right? And so we have an idea about the reason I mentioned that we're going to roll out 6 new markets this year is we figured out how to break through that. And it's largely working with the industry. We've always worked with traditional real estate agents. 99% of the homes we buy, an agent represents a different agent represents the other seller. 99% of the homes we sell, the buyer agent is somebody else at a different brokerage that we work with collaboratively. And so we figured out a way to work with the industry so that we can sort of open it up to more of the industry and they can bring customers in the door. That'll help a lot.
Okay, and then so what new markets you plan to go into? You've talked about the 6 that you're already in. How what's the aspiration over the next sort of 12 months?
Yeah, so just like from a methodology perspective, when we went into this, in the worst of 2008, Trulia was, let's call it 5 million unique visitors. We were 3 or 4 years in, and we were nationwide. And we had a lot of data, and we started to turn that data over to the journalists and say, like, this is where people are searching. This is what's happening. Because, the mortgage crisis, all the values of homes were going down generally, but it was like 100 different markets within the US all moving at different rates. And you saw things like Nevada, which was like the foreclosure capital of the world, sort of like falling off of a cliff. But then you saw places like Minnesota, which like maybe they went down a quarter of a point every 3 months, like really a non-event, right? And so we like dug in to figure out in our data where people were searching, like what made those insulated markets so insulated. And Dallas was one of those markets, more sort of a big city. And what we figured out was there's 42 different criteria that we figured out actually insulated. Obvious things like diversity of employers and industry, right? If back then you were in the travel industry, you were like Nevada and in Las Vegas, you were kind of SOL. And that's why it sort of dived. But if you had a lot of diverse industry in your market, then you sort of like could withstand it. Like your whole economy wasn't dependent on one industry, right? And there was a lot of other nuanced things, you know, non-secondary markets, you know, like Miami took a dive because it's mostly second homes, like vacation homes, and a lot of international buyers, and that just dried up, right? But like, you know, Jacksonville, Florida was fine because everyone just moves within 10 miles, right? And there's no speculation or secondary homes. And then there's like 40 other criteria. So we modeled this coming into NOC. We had this model, we had a full-time economist to sort of interpret the model to journalists back in '08 on the news every week. We took this model and said, all right, let's apply it. This is like, you know, 10 years later in 2015 when we started NOC. Let's apply it to the market now. What we found is there's 60 markets, now like 65, that look now like Dallas did back in 2005. And they are these secondary cities where everyone, especially millennials, is flocking to. And it's Charlotte and Raleigh and Dallas and Fort Worth. And, you know, Austin, we just launched. A lot of people from the tech community, both in San Francisco and New York, are moving to Austin. There's a lot of companies moving to Austin. And so our markets look a lot like those. Denver is one of them that I think we've publicized. Parts of California, not Hollywood. Not Beverly Hills, probably not Santa Monica, but there's lots of places that make more sense where the housing stock is more typical of the median house price in the US. And so it's all these secondary cities where people are flocking even more so now with COVID. And there's a lot of data, and there's just a lot of housing stock and a lot of demand.
Right. So it seems to me like you need to have relative uniformity of houses, mid-range, good data so that you can do the analysis around it. You need to be very good at predicting how much the new house is going to cost. You knock off your 3 to 5% you get as a discount for cash. You know how easy it's going to be to sell the old house, because that's the critical element of this. You know how much it's going to cost to upgrade it, because it's always about 10K. And then you know that the transaction will flow within a 90-day period. So you need to basically tick all these boxes to then be secure to know that 95% of the deals are going to flow naturally through your system.
Yeah, and our hypothesis is like many marketplaces. We start where the density is because you have the data and the demand and the transactions. And then we start, even within like Atlanta, for example, which was our first market, we started very centrally and then worked our way out, because at some point, like, you don't go too far out of Atlanta when you start getting properties that are like 2 acres, which are really hard to price. But over time, you start to work the edges and figure out how to price homes where there's not as much data, where there's not as much liquidity, and you get more comfortable. And you also get more representation and more customer demand that tells you kind of, you know, what the price point is. So we see that land and expand opportunity in all these markets, where we land in a major city and then work our way out from there.
Yep. Now, how much have you guys raised over time?
Several $100 million in both equity and debt, and from amazing investors like RE here in New York, Foundry Group in Boulder, and a whole long list of others. Redpoint, who is behind some other big real estate transaction platforms, and a lot of other, you know, debt folks that, you know, are taking bets on the housing stock that we're purchasing. Okay,
and then the final question I've got for you is when you look at the iBuyer models that we hear around the Zillows and Open Doors of the world, right? They're investing a lot of money to lose money, which seems to be at the moment, right? The cost of buying the stock, the sale of the stock, the improvements, and you do all the maths and you lose a bit of money on each house rather than making some money on each house, and you're aiming for some super scale to get these returns. In your model, is it easier to be cash flow positive faster?
Yeah, we've been cash flow positive from a unit economic basis pretty much from day one, because we have, we're not taking risk the way a traditional iBuyer is, when you're not only taking risk on market movement, but also like you're the one maintaining that house, mowing that lawn, shoveling that driveway, fixing the heater when it breaks, and it's out of your bottom line, right? And the financing is out of your bottom line because you're taking all the risk up front. We had a thesis in the beginning. We just thought that model is okay. It's expensive because they're taking a lot of the risk, they're taking a lot of the ownership, and that certainty is worth something, right? Like it's worth, if you're going to ultimately give up 15% of your equity, because kind of that's where it's at right now, 10 to 15%, and selling your house outright like that because they're taking on all that risk and all that expense. That's okay for a segment of the population that says, you know what, it's totally worth it, I'll pay it. But like most Americans need the equity in their home to move up in life, literally to a better neighborhood, a better school district, a better, bigger house for their family. And so we didn't think that made sense. It was sustainable from like a mass market solution perspective. I think it's tough. I think it's going to get more expensive as it gets riskier. And I also wonder, in COVID, all of the iBuyers canceled thousands of contracts, right? And so they are in contract to buy someone's house, and thousands of them got canceled under the guise of, being safe. They were empty houses. So I don't know how seeing empty houses in a tight market is not safe, but those sellers, now they probably had offers on other homes that were contingent or non-contingent, and they lost their escrow. Even if they got paid back, they lost their house, right? And then the realtors who represented the other side got screwed because they got scrambled and, had to basically figure out how to get their customer out of the deal and find a new home in a market where there was very little inventory, especially empty inventory. And so it just proves that model is hard in hard times. And ultimately all of the costs that they bear and all the risk that they bear has to be paid by someone. Right now, it's being subsidized by their investors. To your point, they're losing every money in for every home they do. But even at scale, if you're making 2%, which I think publicly what the analysts say Zillow aims to make, that gets blown up in a market like right now where things change, or something like 2008, even something 10% of 2008 happens, that 2% just evaporates. And at scale, if you have thousands or tens of thousands of homes, that's tough. So like we've tried to really figure out, how do you get the same certainty and cost effectiveness and convenience without giving up all your equity? And how do we sustain a business that we can keep that promise? When a lot of those folks in Phoenix and in Dallas that had, contracts canceled by the iBuyers, we got them. Like they came to us and said, can you help? And we were open for business because we were buying the new house. We were doing it on merit, on what their old home was worth. We knew that there was little inventory, it would sell quickly, and we were able to save a lot of those folks because the model just makes more sense.
Okay. Last question is, how many transactions have you done?
Several thousand. We don't publicize all of our numbers, but we're into the several thousand numbers. If you look on Zillow and Trulia, we have, 800 reviews, 5-star reviews, and people write like sort of mini essays about what the experience was like. So we're hoping to double that this year with doubling the number of markets and just sort of like really get this out into a more mass market scale. We're as a group, if you look at, just for perspective, if you look at the US and there's 6 million homes bought and sold every year, the whole group of prop tech companies that have been, now raised billions of dollars, I think we represent collectively 2% market share. So it's like wide open.
Yeah, a lot of money's been invested.
Yeah, totally.
2%.
For good reason.
Let's hope. I honestly, Sean, I love what you guys are doing. I think when I've looked through the iBuyer models and I've looked through all the different nuances that are going in the market, this seems one that it feels more natural in the process. It feels like you're solving a real problem. And doing it in a way that is de-risking it for everyone in the process. So congratulations, well done. I love what you guys are doing.
Lots of hard work to go still, but thank you, I appreciate it, Simon.
Okay, thanks Sean.
Thank you, everybody.